Welcome back. Today we're doing Smith Wesson. They have a market cap of $785 million with an M, million. So I'd said I was going to stay away from small cap stocks, but this one is just way too good to pass up. So at first glance, this is probably the most undervalued thing I've ever seen. Look at this, PE of 3. What? That's insane. So what we're going to do is look at the share price history and then do a deep dive into the financial statements, see if we see any red flags that would justify this share price, or see if we think it's super undervalued and maybe the chance for the deal of the century, right? Let's get started. So what I have here is a 1 week trend, and I just want to show you. On Friday, they dropped 28%, 28.5%. That's crazy. And why did they drop like that? Because they had a small earnings miss. In general, earnings misses present some of the best buying opportunities because on top of everybody freaking out about the earnings miss and shorting stocks, you also have all these AI systems, these AI trading bots that will pick up on any bad news articles and start shorting the stock. And on top of that, if they see momentum, it can start triggering stop losses for other people, which causes the trading bots to short it more. It can become an amazing buying opportunity. I watched this happen Friday, and I've been watching this stock for a long time, and I didn't buy it yet, but I'm just going to give a disclaimer here. I don't own any right now, but I am planning to buy some this week after doing this video. There are going to be some red flags here, I guess kind of yellow flags, especially surrounding the inventory and just the general cyclical nature of the gun business, but we'll get to those as we make our way through the financial statements. So let's get started with the income statement. First up, total revenue. That's always what we look at first. We'd love to see this growing, and look at this. It is growing. I think what worried people is that they expected it to grow a little bit, and you had 2 consecutive quarters that were lower than the previous. But look at it compared to previous history. It's still significantly higher. It's awesome. All right, let's go to gross margin. This is what we use to judge competitive advantage. So this is just gross profit divided by total revenue. What's gross profit? Gross profit is total revenue minus your cost of goods sold. So cost of goods sold are things like raw materials. So, the pieces and parts to make the guns. In general, I like to see gross margin over 20, and we are way above that. Look at this, 45% gross margin recently. That's awesome. That's a sign of a company with a really good competitive advantage. And Smith Wesson has a competitive advantage, right? They've been around since 1850s. So I don't see them going anywhere. And this gross margin kind of proves that they do have a strong competitive advantage. All right. Next, I want to get to pre-tax income. That is our first valuation metric. Let me go back to dollars here. All right, so first impressions are I really don't like this pit here where you were making close to $0 for 3 years straight, and shareholders might be worried that we're headed back in that direction. What I like to do whenever I see changes in pre-tax income is try to figure out if it's a change just to the revenue that's causing this or if there's any expenses changing. So before I get a valuation, I want to quickly show you the SG&A because I think this is interesting. All right, so look at this. So remember that 3-year period where they were kind of flatlined? It was 2017 to 2020. Look at their SG&A expenses. They were high. They were at a peak. And then they increased their profit by cutting back on those expenses. So if I go back, this is whenever they had their boom in income. So I'm going to go back to SG&A real quick because look at this. That was great, but they're actually on the way up a little bit. So the question is, was this a temporary cut that's not sustainable and it's just going to momentarily boost earnings? And I think that's definitely going to be one of our red flags. If you're going to invest here, you're going to have to feel comfortable with that answer being maybe it was temporary. All right, so I'm going to go back to pre-tax income. And to try to account for this a little bit, I'm going to take a big average. I'm going to take an average of like the last 3 years for pre-tax income and get a number. So the average of the last 3 years for a quarter, which would be the last 12 quarters, was $36.5 million a quarter. So if I go up here to the calculator, I have $36.5 million per quarter times 4. That gives us an average yearly pre-tax income of $146 million. So that's what I'm going to put on the left-hand side here on the outline, $146 million. All right, next I need to get a growth rate. So what do I do here? Usually I say, what is it now? And what was it 5-6 years ago? What I'm going to do instead is just kind of take our minimum growth rate of 2%. I know that's kind of lazy, but I think it's definitely super conservative. And I had $36.5 million for the pre-tax income, which puts us about right here on the trend. And you can see it's about even to where we were 5-6 years ago, maybe even lower from this. But I'm just going to put 2% for growth. Remember, I'm trying to be super conservative here because I'm looking at this as a potential investment. All right, lastly, earnings per share, diluted earnings per share. All right, let me get decimal points in here. Same pattern as the pre-tax. We got this pit here where we were making close to zero, a recent boom, and it's starting to come back down. So I'm sure that's got a lot of people worried that we're falling back down into the bottom of the cycle. So what I'm going to do is take the same thing, take an average of about the last 3 years or so. So the last 12 quarters. So if I do it in the last 12 quarters, I get an average earnings per share of 52 cents per quarter. So 52 cents times 4 is 208. So $2.08. So I'm gonna put that in the outline section over here. All right, sweet. Let's go to the balance sheet. First up is inventory, because I want to show you this, because this is super interesting, and it's also one of those red flags I talked about. Okay, so you can see here, inventory was building up for a while, and this is whenever they weren't making that much money, so they were obviously sitting on a lot of inventory. And then what happened is during COVID and during the riots and everything, they unloaded, no pun intended, a huge amount of their inventory, and now it's starting to build back up, which in general, inventory building back up, especially finished products, is a sign that you may not be having as good of sales because you're starting to build up finished product on your floor instead of sending it out as soon as you make it. So let's look at that real quick. So I'm gonna look at finished goods first. And yeah, this is kind of what we were afraid of. So if you see growing inventory like this, you should be really worried. And you would have been right, because if you remember in the income statement, they had that stagnation period from 2017 to 2020. So it was right after this big inventory boom. So this pattern here kind of can make you think that they might be hitting something similar. So this definitely makes me a little worried. I'll just look at raw materials real fast. Yeah, same thing here. In general, raw materials increasing is a good sign because that tells you that the company is expecting to produce more and sell more. If you ever see finished products going up and raw materials going down, you need to run away. So this at least makes it okay to me, but it's still kind of a red flag, and I'm a little worried about that, not gonna lie. All right, let's go to total tangible assets. So what we're going to do here, I'm not really getting anything from this chart. I'm just going to use it to get a return on tangible assets. So what I do is I take our pre-tax income, which was 146 million. And I'm going to divide by the most recent value for total tangible assets. So the most recent one was 480 million. So up here in the calculator, 146 million divided by 480, 30% return on tangible assets. That is very strong. Next, I want to look at number of shares outstanding, number of ordinary shares, because this is going to tell me if they're diluting shares or if they're buying back shares, right? So if you see something like this, that's not a good sign, because that means that your shares are getting diluted. If it's decreasing, that is a good sign, because it usually means the company is buying back shares. And most of the time, if management is smart, they only buy back shares whenever they think it's at a discount. So obviously they thought the stock was at a discount for the quarters in the middle of 2020. But this most recent one, they didn't do any buybacks. So I'm going to do something I normally don't do. I'm going to pull up the stock price again. And I'm going to go to a 6-month chart, because this quarter was the quarter ending in October 2021. So that means it was from August 1st. So when was that? About August 1st right here to October 31st. So this section. And they did not buy back any shares during this period. That's a little concerning, but not too bad, because the stock then was much higher than it is now. I mean, if you look, it was 24. I guess it got down to 20, which is still about 20% down from where it is. I would hope that if they were buying back stock, but see, they were doing it in this quarter, so that's a little confusing. Let's see. No, okay, they were doing it back here in the teens. Okay, so that's where we are now, so that makes sense. So I would expect them to be buying back shares again if they truly think it's undervalued. Okay, this makes sense. In a way, this is kind of giving you what the company thinks is a fair value of its stock, right? It doesn't want to buy it, it seems like, over 24 or so, over 22. Just keep that in mind. We're well below that right now, though, so it's nothing to really worry about. All right, I'm going to take this back down. Okay, let's go to what's next. Tangible equity per share. And we're going to use this. Well, first, I like to look at this pattern. Bring the decimals back in. Okay, so tangible equity per share is also tangible book value per share. So this is like the company sold all of its assets that were tangible and then paid off all of its liabilities and paid that out to the shareholders. This is kind of what that value is trying to estimate. This is like a net worth of the company. And I love to see this growing, and it is growing. So this gets a check mark from me. And what we're going to do from this is get a return on tangible equity on a per share basis. So we're going to use our earnings per share, that $2.08, 208. Divided by, I'm just going to say 7. 208 divided by 7. 30% on tangible equity. That's also amazing. So really strong return on assets, really strong return on equity. Real fast, let me just get a price per book, a tangible price per book. So to do that, I take the current share price, 16.33. That's what it's currently selling for, divided by 7. And we get 2.3 is our tangible price per book. That's low too. So a low PB like that combined with great ROA and great ROE, this gets the balance sheet, huge check mark from me. So let's revisit that share buyback program a little bit too. So remember, I always say you only want to buy back your shares if you're a company if you can't do better with the cash, or if the stock's not selling at more of a discount than what you can do with that cash. For example, if you're getting 30% return on equity, the stock would have to be at a 30% discount in your mind for you to buy back shares if you were a rational manager of a public company, right? So let's just real quick, I said they weren't really buying above 22, so 22 times 1.3, that tells me that they probably have a price target on their stock of about $29 a share. That's very crude estimate, but I kind of trust it. I think that's going to come in close to what we get. All right, let's go to the cash flow statement. Free cash flow is up first, and you can see here recently big negative in free cash flow. Not big negative, but a big drop. It's a small negative, but a big drop. This probably spooked a lot of people. Probably saw negative free cash flow after seeing quarters of huge free cash flow and got scared and sold, and that's definitely contributed to that share price decline on Friday, I would assume. I think it's pretty easy to know why the free cash flow happened, right? Remember the inventory trend? The inventory trend climbed up and then dipped off right here. So if you're sitting on inventory and you offload it, you're going to generate a lot of cash. But as you're building inventory, you're not really generating cash because you haven't sold that stuff yet. So that's kind of what's happening now. Since we're generating inventory, our free cash flow is going to be low. And then if you ever unload it or you stay stable, that's whenever you start to get normal free cash flow. So I'm going to be conservative here too, and I'm going to take an average of the last 5 years. So that's the last 20 quarters. So if I do the last 20 quarters, all right, I get an average of $30 million per quarter. So $30 million per quarter times 4 is $120 million per year on average of free cash flow. That's going to be my number. All right, and then real quick, I'm going to look at dividends and buybacks. So dividends, they started paying a dividend recently. That's nice. Like to see that. It's not a huge percentage of their free cash flow though, so it's just kind of like a bone to shareholders, I guess. But I'm not a really big fan of dividends anyway because of the double tax, so I'm okay with that. And then what else? We're not going to talk about share buybacks. I talked about that enough in the balance sheet. So let's go to valuation. We've been waiting too long for this one. All right, first one, pre-tax times 10 divided by the number of shares. So 146 times 10 divided by 48. And I get $30 per share. Remember their number was 29? Isn't that, it's almost like I planned it that way, right? All right, so next is going to be our earnings per share growth formula. So 208 times 8.5 plus 2 times 2. Now, remember, we use the minimum growth rate here, and we get $26 per share. Seems reasonable. But look at this. We used a conservative earnings per share and a conservative growth, and we're going to get something that's, what is 26 divided by 16? That's 60% upside from the current stock. What? All right. And then lastly, I'm getting ahead of myself. Free cash flow. 120 million is our free cash flow number, perpetual growth rate. I'm going to do 2%, discounted at 15%. And that gives us a net present value for the market cap of this should be million, it's not billion, so $1 billion. So 1,000 million or $1 billion. So 1062 million divided by 48, and we get $22 a share. Still very good upside from the current share price. So 22 divided by 16, that's 40% upside. All right, so all three of our valuations came in significantly higher than the current share price. It just had a massive sell-off to 30% based off some earnings fear. This is one I'm going to be buying this week. After doing all the research, I understand that there are some red flags. I'm okay accepting those risks. You might have different risk tolerances, and so each situation is different. You really should do your own research. Don't just take my word for it. But anyway, I hope you enjoyed the video. I hope you learned something. If you did, please like and subscribe, and I will see you next time.